We'll keep it very dynamic and very brief to cover many points. One point made earlier by Inside Partners is actually time to IPO is getting much longer and the IPO evaluation getting to be much higher. How does investors like yourself deal with the challenge of growing companies now for IPO or growing companies for a much longer period of time? Daniel?
I think, that's a general trend, right, you see in the market. And I think for deep tech companies, which are the companies interesting for us, it's not a completely new thing because you have, let's say, usually a longer life cycle anyway. And so I think for us, it's easy. We want to be a very reliable and long-term investor. And with the backing of Siemens, we have the capital to do so. Therefore, we are in the game and really excited about this trend because that means we can build even bigger companies.
Irit, as a VC that invested primarily in earlier stage and now actually advancing to growth stages, how do you see the kind of like the investment landscape in terms of who would you partner with when trying to build or scale up a company, or kind of like how to form the group of investors around a company that is ready to scale?
Yeah, so we started off in 2015 and then we backed earlier stage companies 2016, and since then we have a focus on late stage globally. So we have an office spread in Silicon Valley, Asia, Germany obviously, and Israel. In terms of your question of who are we syndicating with in the growth stages, so it's a very clear answer with the earlier stage investors on a global scale, because companies need to expand very early on in their life cycles. Yes, time to IPO we see is much longer because, as Inside also in this morning said, Israeli companies are not being in the game for being sold very early on. They're expanding and building large-scale companies. Exit valuations are going up as well. And another thing I wanted to add to Daniel's comment is we're very much SaaS-focused, which means data-driven investors. We're focusing on, we have like in our benchmarks more than 500 companies that we run through our kind of models, and we track companies, and execution is becoming key. So it's not only the product, it's also the execution. This, I think, is what's changing, because the bar for IPO has become much, much higher today.
Sure. Daniel, I know that you wrote a great applaud for selling Dynamic Yield. I think you were co-investors in Dynamic Yield to McDonald's. I think it was kind of a unique acquisition in the Israeli landscape, where a company which we don't usually see as an acquirer actually getting to the scene in order to add this company to the portfolio as an operational manner. Do you think that we can learn something from this acquisition for the future acquisitions that are likely to happen for companies who have stable operations well beyond the technology?
Well, I'll be lying if I say that we knew that the company will sell to McDonald's when we invested. Dynamic did a software company. Basically, they built a great personalization products for e-commerce. So when we wrote the memo, I think we wrote the memo in 2016, we had 42 potential acquirers in our investment memo, and McDonald's was not one of those 40 companies. So I can take credit for that. I do believe that things are changing. You know, if you keep doing what you've done, what you did, you're probably not going to succeed. And I think now investors need to add people like McDonald's to the list of potential acquirers. On McDonald's, I wouldn't count to do many more. The last acquisition before Dynamic Yield, I think, was the Chipotle, which is not really a tech company. But I believe that it's we're going to see more and more of these strategic brick and mortars companies coming into Israel. We already see that.
Okay. I know that we spoke a lot in this conference about urban living and kind of like innovation for millennials living in the city. We see this company traditionally kind of like picking a trend or believing in sharing economy, new kind of like diet trend or something like that, building a company, but quite too often these companies do not meet the potential later on when they're kind of like try to operate at scale. What's the mechanism we reach to evaluate companies that are actually going to a large consumer market and trying to understand the potential as an investor?
So we are actually more focused on B2B, less on B2C. So in terms of consumer market, I think the metrics are very, very different if you look at B2C companies than B2B. One thing that we always measure in terms of when we look at companies is engagement, user engagement, which is very, very, very important. One area I will divert a little bit for millennials, and a trend that we see and is a little bit connected is the deskless workers, the mobile workforce. We see kind of an increasing trend in all the verticals of the millennials. They don't have time to sit down and, in front of the PC. Everything is on the go, everything is done on the run. So we see a lot of applications for consumers that are being used to manage all that kind of productivity and workforce operational workflows on the go. So user engagement is super, super critical. Frequency of usage and retention is super, super key in evaluating these companies.
So we understand that evaluation now becomes a matter of interaction, engagement, churn, lifetime value. So we have new metrics to evaluate operational companies. Daniel, how do you do that, given that you're also coming from large corporate traditionally, that seem to kind of like scale product and services?
Yeah. I wanted to add one comment exactly addressing this question. I think the thing B2B companies can learn from B2C companies is actually, I mean, some of the KPIs which are used, you have to know them when you build a B2B company, because it's very similar. So if I think, for example, about unit economics, right? I mean, it needs to work for B2C companies, but I mean, it also needs to work for B2B companies, and I see it too often, especially in let's say deep tech companies, that they don't think about the unit economics right at the beginning, because it's more this engineering or tech thinking. Somehow the product will work, the technology will work, and then I will figure out how to make money. And the second thing is, I mean, user metrics, right? User engagement metrics. That's a very, very important set of KPIs we are considering if we do B2B investments, because things like how much time is the user spending with the product, it's crucial, it's very important, and it doesn't matter if it is a B2B software platform, if it is a consumer game, or if it is a hardware company. You want to see that users, doesn't matter if it is business user, consumers spend time with the product, and that it is somehow increasing and there is stickiness.
I sat with my son. My son is 11 years old, and I tried to explain with him something that we had in the paper that morning. We heard that just one of the large kind of like sharing economy companies was raising against checks of billions of dollars, and they had the sub-headlines saying that they were losing like $400 million this year. Oh, yeah. And my son, he's only 5th grade, he doesn't understand mathematics, says, how come they raise so much more capital if they're losing so much money? And honestly, I don't know if I had the answer for him. Daniel, I think after WeWork and after some of the latest investments in kind of like sharing economy companies, operational companies, pouring more and more capital into losing companies, are investors doing the right thing?
Well, first I'll say on WeWork, it comes up on every panel for a while. I actually think it's easy to kick people or companies when they're down, but maybe it's a better sport to try and kick a goal instead. WeWork built a company with a really strong brand, strong product. We have many companies using their product. They're active through hundreds of cities and employing thousands of people, and I think they built a great product and company. And again, investors may not have done the right thing, picking the right valuation, etc. But we should separate between very strong and successful company that have done wrong on the valuation side to just companies who can never make their product work. So I actually like WeWork's product, and I think again what we need to learn from that is maybe how to better calculate valuation and try and make reasonable bets when we invest. But on the product side, still, many of those sharing economy companies, that you call them, have strong products, strong brands, and they will exist. The question is, who is going to make money? Only the early investors or also the latest ones. And there are also a few companies that the business model doesn't work, but I would be careful and try and separate between those two. I didn't read the story you were referring to, so I don't know what's the right answer to your son, but I would focus on the product. If it's a great product, then it makes sense for them to continue and raise money.
So, would it be a product market fit, or whether it's a good product, so we'll test actually the quality of the product or the engagement, whether we really need to sit down, go to the basic mathematics and understand unit economics, understand kind of like margins, understand kind of like the competitive products, and trying to come up with some financial formula for these late stage investments, which seem to kind of like attract a lot of the capital now in the VC market, but not necessarily the highest returns.
Yeah, I think it's all of the above, but as we go on and later stages, then numbers are becoming more and more important, and that's something that even early stage companies need to start taking more and more into account for raising the next round. How am I going to execute and really make sure that I'm going into the next round, which is 12 to 18 months from now, with the right KPIs. So on WeWork, I think the jury is out, right? So capital efficiency is very important when taking company public. You cannot just burn forever for growth. You have to be shown, or at least have to have a path of profitable growth. Even if you're not yet there, it needs to be seen that it's going that direction. So as more and more late stage you go, capital KPIs and numbers are becoming increasingly important.
Okay, now shift, if we spoke a lot about kind of like consumer products and sharing economy, now Daniel, with your permission, let's shift a little bit to the B2B and kind of like more deep tech products that are integrated now into large companies. When we talked earlier, you said that you believe that the POC, or kind of like this product market fit and working with a large corporate, is essential. How would you describe the path that you assigned for portfolio companies in validating the product or in kind of like perfecting the offering?
I think if you're in the 0 to 1 stage, if you have a B2B company, I think it's important to prove your product, to further develop your product with POCs. But on the other side, you have to stay very focused. I mean, what we see very often with tech companies, they start a lot of POCs with different customers in different regions, and every POC is a huge time assignment. So at the end, you need to be very thoughtful where you allocate your time and which POC and which customer really brings value further developing your product in this phase. And sometimes it's better to just have a handful because in this phase it's not about generating a lot of revenue, it's about refining your product. And once your product is ready, then you're ready to scale with more customers.
But Daniel, let me a little bit challenge this hypothesis about focusing on one POC or very few POCs. It is very common that an enterprise started a POC but dropped the POC for a handful of reasons, resources, priorities, or handful. If I'm going to one POC or two little POCs, I could be left with nothing. And furthermore, I think that part of the journey of perfecting your product or the product market fit is getting more feedback, and sometimes you get too locked into the assumptions or kind of like the business model of the one corporate you POC with. How do I choose enough POCs but not too many?
Yeah, I think, I mean, I would ask myself, what are the right companies or customers for POCs? And to be very honest, I mean, as our backer is Siemens, I'm not sure if Siemens, as a huge conglomerate, is the best company for POCs. I would rather go to a German Mittelstands company because maybe some processes are much faster to onboard a young company. So I think for me it's more about being very thoughtful about the election because it avoids a lot of obstacles then later in the POC executing it.
Irit, I know that your VC started with Deutsche Telekom, but later raising your next kind of like fund, you brought along many other investors. But Could you share with us a little bit about what's the process of validation that you had with Deutsche Telekom or similar enterprises that were your LPs in validating a portfolio companies? What's the process for a venture capital that emerged from a large corporate in the validation process?
So we emerged, we were set up in 2015, as I mentioned before, as a first fund, and all the money came from Deutsche Telekom, but we were never kind of strategic, or we were from the beginning independent, but our close partnership with Deutsche Telekom is definitely important, as we have some companies that are forming strong strategic partnerships with Deutsche Telekom, and that's validity for us as it works. We don't need it in terms of investing in our companies, but it's another kind of checkbox that if a company manages to close something with DT or with a corporate, which takes a long time sometimes, but those partnerships are very important, so it's another validation. As I mentioned, we don't need it in the process. I just wanted to add in kind of POC stages, it always depends what your go-to-market is, right? We see the best companies in the market as we also go more and more kind of cloud 3.0, open source. We see more and more companies product-led, right? So kind of coming from the bottom up, which is key, I think, in these days and in the environments that we're investing, and not only top-down.
Sure. Daniel, I don't want to embarrass you on stage, but beside being the...
So don't.
That was an introduction for embarrassing you on stage. Beside being the nicest person in the VC industry, you are my favorite author, as you just published...
Mine too.
Yeah, just published a book that was read by anyone in the high-tech industry. But most interestingly, when I read your book, I realized that probably there are a lot of similarities between being a good investor and a good storyteller. So could you share with us about what is the way of forming a narrative that, as you did in your books, you do in forming a decision to invest in a company?
Well, we established you embarrassed me, so you can also tell a story. Look, I think at the end, you look at a company, you're looking at a story. You know that the CEO, the founder, needs to tell a great story to the employees, to retain them and to keep tracking them, to his investors, because you have to continue and raise more money, and eventually to a potential buyer or to the public at an IPO. And again, as an investor, we're on the sidelines, we're the cheerleaders, you know, we're not the ones driving the car. So we're not the one telling the story, but you need to be able to recognize a good story when you see it and to, you know, pick the right hero for your stories. So
what makes the right hero in a startup company?
Well, good question. I think for me, like in any Hollywood movie, it needs to be someone that you, one, relate to, but also you aspire to. So it's not, they're not a day-to-day figures, but people are a little bit larger than life. And you know, you need to be a little bit crazy to be an entrepreneur, because the odds are against you. So the combination of someone with a little bit crazy, but is also smart and in a way down to earth, so he knows what bets to make. That's a combination between, again, kind of an aspirational figure and a great manager.
Irit, now it's my time to embarrass you. Yeah. I think you were...
Good luck.
What?
I think you were inspirational to many women by taking the role of actually a managing partner, managing director in a large venture capital early on, when women could not see many other kind of like role models. I know that you took this role very seriously and decided also to set a forum for investors and to set the road. As we spoke earlier in the conference about the importance of the representation, how much kind of like millennials assign importance to equality and representation. What do you see your role and role of additional kind of like women investors in promoting more women entrepreneurship and better representation in the industry?
Yeah, so I'm managing, as Nimrod mentioned, a forum in Israel called Women Founders Forum, together with 2 other partners in Israel. And we're focusing very much on bringing quality kind of to the startup scene in terms of bringing quality framework, not only talking about it, but really kind of doing something together with female founders. So I think our kind of job as investors or people in the VC scene is kind of bringing more and more females into the VC community and helping them really kind of giving them a hand so that we have more and more kind of female founders or investors in our community. We do this by giving them the right skills and content and connection. So my network is open to them, to the female founders that just start raising companies. We actually see a lot of good talent, tech talent, more and more kind of deeper technology that they're focusing on. And we got only this year we got more than 100 applications. We could only take 10 for an annual program, but we get more and more founders that we see that are starting a business in the VC industry.
I wish I had more time to embarrass you and ask further questions, but unfortunately I'm being told that the time is up. Thank you very much for your great thoughts and observation about the VC market. Thank you very much.